So, as a lot of you know, Jim Simons was a world famous mathematician and billionaire investor who's had massive success running his giant hedge fund called Renaissance Technologies, one of the biggest in the world. I believe it's usually ranked like second largest, it's right up there, it's huge. Anyway, running that hedge fund, he implemented his own expertise in mathematics and statistics using quantitative models to determine the best possible investments, which gained him an average return of, get this guys, 66% per year for decades under their flagship medallion fund. Now for context, S&P 500 was only averaging around 10% during that same time. So it's really amazing how effective his algorithms were at choosing the best possible investments at the right times and just getting them giant returns. And as such, he was sort of named the mathematician that could solve the market or kind of beat the market. It was all really interesting work, and the man was really looked up to by many in the investing world. Now, unfortunately, due to a battle with lung cancer, Simons passed away earlier this year during the second quarter, of which he was still serving as an advisory chairman and likely still had a lot of influence over the fund's investing decisions, particularly their flagship medallion fund, which he was the largest investor of that fund too. Anyway, as we usually do with famous investors and giant hedge funds, today we'll be looking at the 5 largest purchases that they made during that quarter, which theoretically may have been the final purchases that Simons had some oversight of. Although all of his strategies and of course algorithms will continue to be used well into the future either way by Renaissance Technologies. Of course, we've done these videos several times in the past for Simons trades, so it is pretty sad to now have this be kind of the final time that we'll be able to do this for Simons. And I do just want to say that, of course, our thoughts and prayers go out to both Simons and, of course, all of his family and friends. With that said, we'll run through the 5 largest of these purchases. I'll give you my own opinion on each one, and as always, I'll even rank them from best to worst too, based on my opinion as well. Okay, so let's go ahead and jump straight into it. Now, we'll be sorting these purchases here from smallest to largest weight in the portfolio, with purchase number 1 being the ultra popular video streamer Netflix, ticker symbol NFLX, which was a new addition in the quarter for Renaissance, picking up over $180 million worth. And when it comes to Netflix, well, I actually used to be very sour on it myself. I just couldn't understand why anyone would want to own this stock as opposed to maybe something like Disney or Amazon or Apple or even Google, all of which have deep exposure to video streaming but are just so much larger, so much more profitable, and so much more diversified. And in many ways, I do still feel the same way about Netflix today. However, I will just say that Netflix is perhaps growing on me a little bit more this year, especially given the strong earnings that they just posted for the second quarter, where sales rose by 16%, while more importantly, their net income profits actually soared by almost 40% as well, with both figures beating analyst estimates too. And when looking at subscribers, well, the average revenue per user rose by 7% too, thanks to price increases and a crackdown on password sharing, which is, obviously not popular among consumers, but it's helping their business, while subs still put up 16% growth too, slowly approaching 300 million, making them the second largest SVOD provider in America, pretty much tied with Amazon, according to Statista. On top of these impressive numbers though, another thing that's been catching my eye lately about Netflix is really just how they're now trying to at least diversify as much as they possibly can within just that kind of single video streaming field. And for example, they're adding live events like the upcoming Paul versus Tyson fight. They've been having live comedy events. They had Joe Rogan do a live comedy event recently, which is very popular as well. They've been doing stuff with the NFL. They've been doing other TV programming, and they've even added a ton of video games too, which is pretty interesting. And by the way, a big reason for the sudden rise in profitability has also been attributed to their new ad-supported business, where you get a cheaper plan that contains commercials, which saw its membership count rise by 34% too. So that's been considered a success as well. Again, though, I personally still prefer much more the vastly larger and more diversified businesses of the other companies that I mentioned before. Plus, I can't help but notice the giant recovery that Netflix stock has already had this past year, soaring right up to a record high. So for me, it's just not something that I want to be jumping into at this time. Although I will say, even at these high levels, their PEG ratio is surprisingly still just a tad bit cheaper than the sector median, which is thanks to the high growth on their bottom line that they're finally experiencing now, with EPS expected to grow north of 23% per year over the next 5 years. So it's a bit of a mixed bag overall, right? It's not a stock that I'm fully against anymore, but because there are better options, I would say, out there in the market, I'm gonna have to pass on this one still for now, and I'll rank it somewhere near the middle because I do feel like it's a bit of a mixed bag. I'll give it the number 3 ranking until I see what else is on this list. Okay, speaking of what else is on this list, well, coming in at purchase number 2, we have another new addition to the portfolio, this time in the popular semiconductor specialist known as Qualcomm, ticker symbol QCOM, which they purchased over $218 million of last quarter. And yeah, this one is a pretty interesting one here because, we often talk about other chips giants like Nvidia or AMD, but Qualcomm is also a very important global player in the space, except they're one that focuses, I would say, much more heavily, of course, on the smartphone segment, where they've actually seen a ton of success as their Snapdragon chips not only power many of the world's most powerful handsets, but they've also helped them achieve the most market share by revenue at around 40%. And look, it doesn't stop there, as Qualcomm has also expanded into many other areas too, like artificial intelligence, computers, the Internet of Things, connectivity, automotive, audio, and even VR too. I kind of think of Qualcomm though in the sense of how like Nvidia dominates, computer and data center GPUs. If you want the best, you go with Nvidia. Well, I think the same can pretty much be said for mobile phone processors. If you want the best, you likely go with Qualcomm, right? Which, by the way, we're probably finishing up the 5G upgrade cycle for phones right now, kind of progressing our way through that. Well, AI could be the next upgrade cycle too, as the new Snapdragon chips from Qualcomm will offer more AI functionalities to be performed locally on your smartphone, which they're even pushing into cheaper handsets too with the new Snapdragon 7 Gen 3 chips as well. So that could convince a lot of people to upgrade their phones, and that could do well for, of course, Qualcomm's business. Anyway, all of this dominance has helped them be solidly profitable year after year. However, more recently, their growth rates have gone through a couple years of correction, I would say, after the explosive growth that they saw during the pandemic. But even still, growth is expected to bounce back next year, while the stock has also performed very well over the years, more than doubling in the past 5. But a recent dip has actually caused the stock to lose about a quarter of its value from the top, leaving the valuation significantly cheaper than the sector by around 20% or more on virtually any metric you look at. So I do actually think that the stock is a long-term buy here. Now, I don't own it myself yet, as I already just have so much exposure to so many chips through stocks that I own in my portfolio, like Nvidia, Intel, Baidu, Apple, even Tesla and Google. I mean, these companies have a lot of direct or maybe even indirect exposure to chips, and I own several others too. So, I don't really feel the need to buy more chip stocks as it is. However, I would actually be open to buying Qualcomm on top of all of this, especially if it continues to dip lower like it has, because they at least would give me exposure to something that perhaps I don't have, that I'm not overly exposed to, which would be the specific focus on smartphones. So I think I just butchered the way I just explained all of that. But my point is that maybe Qualcomm gives me something a little different than that I don't necessarily have already. Anyway, when ranking it compared to Netflix, I think there's probably more growth opportunities with what Qualcomm is doing, so I'm giving them the edge. Plus, they have the cheaper valuation. I think that's important to me. So I would give Qualcomm the number 2 ranking because of those reasons. Okay, moving on to purchase number 3, though. Surprisingly, we actually have another very popular chips company in advanced micro devices, ticker symbol AMD, of course, which was also another new pickup for the portfolio in the quarter, adding close to $300 million worth of the stock. Now, when it comes to AMD, I like to keep it very simple with this one. I kind of look at the big 3 when it comes to computers and data centers, those being Nvidia, AMD, and Intel. And I think all 3 can really be considered a buy when talking about chips for those areas. but in their with their own unique characteristics. So when I look at Nvidia, for example, I think of the most highly valued, but also the most dominant, the most secure, the leader in AI, the most innovative, the most powerful, and really just kind of the highest quality of those three. If you want the best, you go with Nvidia. And I feel like the stock is very similar. You want the best, you kind of go with Nvidia. Now, when it comes to Intel, I think you're going for a legacy giant, someone that used to be a leader in the market, but that has now been beaten down into the ground. And so you're really betting on them making a comeback, turning their business around, and especially as a play on not just developing chips, but actually manufacturing them too, and all for a dirt cheap valuation, the cheapest really of the three. But then when it comes to AMD, well, there, I feel like you're really talking about the cheaper alternative to Nvidia, not just in stock price, but as an actual business model too. They are a cheaper alternative really to both Nvidia and I would say Intel in the GPU and CPU markets. I think that's a very compelling proposition for their business too. And I think that that's just a great spot to be in where they can have a lot of success. Now, I'm personally comfortable with what I have already in Nvidia and Intel, but AMD is very attractive too. And I've owned it in the past and I've made some huge gains on it. It used to be one of my biggest stocks. I made a lot of profit on it, and I'd even be willing to buy back again in the future too. But as it stands, the stock is up over 3,600% over the past 10 years. But more recently, it did actually dip by over 27%. So, a little bit of a mixed bag there. Financially, they saw explosive growth during the pandemic before pulling back last year, but seem to now be back into recovery mode, with sales expected to rise by over 12% this year, before accelerating to over 28% the year after too. And EPS is even better, rising by over 30% on average, which is why their PEG ratio is actually still cheaper than the sector despite that really strong performing stock price. Look, if I was an outsider looking in with no stocks in my portfolio, I would probably choose AMD over Qualcomm as perhaps the better long-term investment. But because I already own so many chip stocks as it is, I kind of feel like Qualcomm would just give me a little bit of, like I said before, exposure into a subdivision that perhaps I'm not already overly exposed to, which is the smartphone chips market. And for that reason, I guess I got to give the slight edge here to Qualcomm. So I will bump them up to number 1 so I can fit AMD right behind them at number 2. But again, both stocks look pretty good to me overall. Alright guys, this leaves us now though with the final 2 purchases. These are the largest holdings of these 5. And coming in at number 4, well, we have Apple, ticker symbol AAPL, which they increased their position on by over 300% after actually selling in a few of the quarters prior. Now, this one does look a little surprising to me because, I actually just put out a video yesterday showing how Warren Buffett and Ray Dalio have actually been selling Apple stock. And my theory is that they probably did this because of just how much the stock has climbed recently. It's not only at a record high, but it's literally the most highly valued company in the entire world at over a $3.4 trillion market cap, leaving their PEG ratio more than 100% higher than the sector. So it is a very expensive stock. And look, don't get me wrong, I do think that Apple has an amazing business with insane financials, a very sticky ecosystem of products and services, and even some future growth potential too, with integrating things like AI into their products and services, or even launching some folding or flipping phones as well that could convince consumers to upgrade. But I just feel that the price is just too high right now to where I can actually understand why some other giant hedge funds have instead elected to sell the stock and lock in those profits instead of buying it, especially when growth is so limited at their already massive size. And we've seen that in their iPhone sales stalling out and overall sales for the company actually falling last year and only expected to grow by 3% this year as well, which is pretty darn low. As for me, I do own a small amount myself, but I'm just holding it long term. I don't want to buy any more at these really high prices, but I also don't want to sell because of how incredibly strong and profitable and how much cash they have, how strong the business is and how much cash they have. As far as ranking it goes though, I think I'd put them just barely behind Qualcomm at number 2, just because the upside potential I feel is so limited already here at these prices with Apple. If the stock was a little lower though, I would for sure put them ahead of them. Okay, that will, however, leave us now, though, with the fifth and final purchase, which is yet another chips stock, and that is in Broadcom, ticker symbol AVGO, which was also a new addition at over $470 million. Now, I say this is a chips company, but really they do so much more than that nowadays too. They do make custom chips for companies, but they've expanded heavily into, especially recently, into cloud computing, artificial intelligence, many different services too, which was only further boosted by their massive $69 billion acquisition of VMware. So much so, in fact, that Bank of America and Goldman Sachs recently called them now their top two AI pick alongside NVIDIA. That's huge. And they mentioned that they consider them a critical piece of the ongoing AI infrastructure build out. And they even went as far as to say that they feel the company could join the trillionaires club in the future alongside other tech giants like Google, Amazon, Apple, NVIDIA, and so on. Now, personally, I love Broadcom. I think the company is on fire right now, which you can see in their financials. They crushed earnings recently too, and their sales and profits continue to soar, especially their profits. But even their sales are also expected to rise by over 40% this year thanks to that acquisition, and then still grow by another double-digit rate the year after too, despite that, which is pretty incredible. The only issue with buying right now, though, is that the stock has already risen by so much, up to a new record high after soaring by close to 2,000% over the past decade, leaving the valuation a bit higher than the sector on virtually all metrics, although the PEG isn't too bad thanks to that profit growth. Like I said, though, I really love Broadcom, but I already purchased all of my shares that I want to have before this huge run up. I'd love to have more, but I made those purchases before this huge run up. Now, I've kind of halted my buying there. That said, I do still like them more than most other stocks out there, and I'm still gonna have to rank them as number one. Although I could see the argument for why Qualcomm would, perhaps deliver better returns at that cheaper valuation if they perform well, right? If they execute and perform well, perhaps there's more upside potential. But yeah, overall, I think I would stick with my rankings here with Broadcom at number one, followed by Qualcomm, then Apple, then AMD, and then Netflix at the bottom. Not a bad group of stocks, so I must say. Very heavy on tech, but I like tech, so it's fine with me. Renaissance does tend to trade in and out of stocks a lot more frequently, though, than others because of the algorithms that they use. So they're not my favorite hedge fund to kind of track, but if they were to be looking at these as more kind of longer term investments, I think they're all pretty reliable businesses here. Netflix is the only one that I think I'd be a little worried about heavy competition in the future, but the others I think look pretty solid. Okay, with that said, that's my roundup there. Yeah, I hope you enjoyed the video. Thanks for stopping by, my friends. I hope you're all doing well out there. Leave your thoughts and comments down below. Do you agree or disagree with my rankings, anything I said here? And let me know if you're invested in any of these stocks. Okay, I'll catch you guys in the next video. Take care, everybody. Hope you're all doing well. All right, bye-bye, my friends.